Currently, there's a lot of talk about the fact that we may be in an investing bubble, especially in things like index funds and ETFs, and the fact that they're gaining so much popularity, it's making people think that it's overinflated and that we're just at the top of this thing, and that pretty soon that bubble is just going to pop and we're all going to drop out. And that might have an effect on the total stock market, individual funds, individual companies, all of this. Big name people are talking about this, specifically Michael Burry. And if you don't know who Michael Burry is, he's the one that called The Big Short. He's the one that called the housing crisis that we had in 2007, 2008. He saw that in 2005, that there was an issue there, that we were becoming into a big bubble. And so he called that, he saw signs like that, and now he's saying that there are signs very similar to that in index funds and in ETFs. And so today we're going to talk about this because my friend Yash asked me, can you make a video on the future of index funds? And he was saying exactly what I just said, which is right now, Michael Burry points out that index funds are in a bubble, as there's some stocks which are way too much overvalued because of the fact that they're just in a specific index fund and not because retail investors would not prefer to buy a specific company's stocks. And so Yash has a great question, and he is on the right path. He says that he's 25 and he has a big time horizon to be able to invest, and so he wants to invest in index funds or ETFs, but he's hearing all this conflicting information. So great job, Yash. And for any of you out there that are thinking along the same lines, I love it. Do your research and come up with some good stuff, man. So here's the deal. The idea is that, first of all, what a bubble is when a bunch of investors, to a certain extent, are buying into something that they have a bunch of hopium. They think that it'll just keep going up. And so the price does keep going up. And so you keep buying in more, but there's really no foundation. There's really no means or reason as to why these things are going up, or it's being overinflated and it can just crumble. And so a bubble, a true bubble, means that there's no foundation, there's no reason as to why the price is going up. And so at some point, somebody's going to buy in at the very top, and then it's all going to crumble. And now whatever asset they bought is now worth much less. And that happened in 2007, 2008. Like I said, people were buying houses for, let's say, $300,000 because that's what they were worth at the time. And very quickly, almost overnight, it felt like that house is now worth $150,000. So half of your net worth in that house is totally wiped out. And that was a scary time. That was a tough time, and it took us a long time to get out of that and get to the point where we are now. And so when we see that with ETFs or index funds, and when somebody big like Michael Burry is calling for that same thing, we definitely need to pay attention. And so first of all, for those of you that are new to this segment, my name is Nolan Gouveia, or Professor G. I am an actual professor, and just like in my classes, I offer office hours for my students that want to go a little bit deeper. And so this section is all about that. So I answer one big question, sometimes a couple questions in this segment, just one-on-one with no edits. And so that's the question for today. So let's talk about index funds. So the actual quote, the thing that Michael Burry said was, the difference between now and 2000 is the passive investing bubble that inflated steadily over the last decade. All theaters are overcrowded, and the only way anyone can get out is by trampling each other. And still, the door is only so big. So what he's saying there, first of all, is in investing, there's this movie theater idea where when you invest, just so you all know, when you buy a stock or when you buy an ETF or something, somebody needs to be selling that. So it's not just this random, you're picking something and you're just buying it. You're literally, somebody is selling it at a certain price and you are buying it at a certain price. And so there's only so many stocks out there. Sometimes you're buying it directly from the company. Like let's say you're going to buy an Apple stock and you buy it from Apple. They're selling it at that price. And then if you're buying it for that price. But sometimes the company is not selling their stock or something like that, and you're buying it from another person who wants to sell out of Apple stock, and so you're buying it from them. And so with that idea here, what Michael Burry is saying with this overcrowded theater idea is that everybody is piling in right now, right? Like everybody is looking to get into the theater, which means get into these index funds or ETFs. And if you were to sell one share and somebody were to buy it, that's kind of like one person leaving the theater, and you can get out totally, easy. You can walk down the aisle. Nobody else is moving. So you walk down the aisle, you walk out the door, you're safe. Good. But if everyone in that theater tried to get out at the same time, let's say there was a fire, let's say there was some crazy catastrophe, everybody's trying to go, there's mass craziness, some people will be able to get out, but a lot of people might get trampled in order for other people to get out. And so that's the idea with the index fund or the idea with a poppable type of bubble like that. If a bubble pops and it just starts dying in price, people are going to try to sell it really, really quickly. But very quickly as well, people are going to see like, okay, if it's an actual bubble, this isn't the time to buy at this point. So they actually can't sell, and so they're not going to get out of the theater. And that's what he's talking about. Now, let's talk about if that's actually happening. So the big idea here is the reason why he says that it's overinflated is because people are now holding company stocks that they really don't care about just because they're buying the fund. Like if you buy the S&P 500 fund or VOO, you're buying 500 pieces of 500 different companies, right? And you care about a lot of them. You care about Amazon and Google and Netflix and these types, but you don't care about like Alaska Air Group or CarMax or Whirlpool Corporation, some of the smaller ones that are in the S&P 500, but you still are buying them, right? And so what he's saying is that a bunch of companies are being overly inflated or saying that they're worth more because people are buying the S&P 500 so much, not necessarily thinking that CarMax is going to go through the roof or something. And so I can see what he's saying there. That totally does make sense. The only big issue here is that literally 94% of ETFs, index funds being traded are being traded by each other. So like not buying the stock itself from the company. So just because I'm buying the S&P 500 and it has a percentage of Apple, I'm not actually buying, or the S&P 500 is not actually buying from Apple specifically and then giving me specifically a portion of a share from Apple. It's more the resale market. And so 94% of all ETFs, all index funds, and the whole market, that whole trading thing, you're buying it from somebody else who's selling out of it. Maybe they're in retirement age, and so they're selling some of their shares, and so they're available. And so with that in mind, that really puts it into perspective that we're not overly inflating those companies' stocks specifically from just index fund or ETF investing. And so, and that 94% came from Vanguard, and Vanguard is a huge company that does a lot of research, very, very smart, looks at all the different things going on in the market. And so for that reason, I don't see there being a bubble in the index fund or ETF category specifically, anything more than what's happening just in the market in general. So for me personally, what I'm looking at is I'm not afraid at all to continue investing in index funds and ETFs, specifically for all of the reasons that I talk about in all of my other videos. The thing that might be a bit inflated at this point is the individual company stocks. And so maybe Apple is showing that they're worth a little bit more than they actually are due to inflation or due to other revenue numbers. And that could be a thing, especially as we saw a lot of the tech companies went up a bunch during COVID, but then died down a bunch now and are having massive layoffs and things. And so we're going to start seeing that price shift a bit. And pretty soon it's going to reshuffle, and then we're going to have the true value. And a lot of these companies are becoming more in that value territory, and they were super high about a year or so ago. And you can see that in the market now. So anyway, all that to say that the The fact is that buying index funds, buying ETFs, and investing in them is not, in my opinion, causing a bubble, and it's not overly inflating the price of a bunch of other stocks individually. And I know that Michael Burry is very, very smart and did call the big short with the housing market, but that was something totally different. He could see, literally, you could see that people were making huge mistakes with mortgages and loaning out these mortgages, because if you're the banker and you loan out this mortgage, you make a pretty big commission. So you're doing everything you can to just give people free money because you make free money. And the more people that do that, of course, that's going to cause a bubble because there's no foundation there. You're just giving people free stuff, and you're yourself taking advantage of that opportunity. That isn't happening here because everything is correlated to the actual company doing actual work and bringing in actual revenue. Like Apple's stock is going up or down based off of revenue or based off of profit, based off of certain actual metrics. It's not just, this sounds good, let's just do this for now. And they're highly regulated. They have to put out earnings reports every quarter, and you can actually go and look at them. So it's something that right now I don't see there being a bubble for that specifically, and I'm not worried at all, and I'm going to continue investing in ETFs and index funds the exact same way I was. Everything is down now because of a lot of other things going on in the economy and even worldwide. So that makes sense as to why everything's dropping. That might be a reason why people are freaking out a little bit, but for me and for all you smart investors, this is going to be just a time to buy stuff on sale. Only the things that you definitely know, right? 100%, you have to understand it. But if you do understand it, I say, for me, nice. For me specifically, I'm buying in. I'm not worried. It's not fun to look at my account and see that it's down so much. But eventually, when we do hit that bull market again, any of us that are buying in right now are going to be very, very happy because we're going to get a head start to the race. And anytime you get a head start is pretty cool. Thank you so much for the question, Yash. And if anybody has any questions or thoughts, I would love for you to put them down below. I'll pick one for next week's office hours. And thanks again. I'll see you guys next week.